buyer closes on a commercial landscaping company. They did what felt like due diligence. Tax returns, 3 years, all filed. Profit and loss statements reviewed, customer list pulled and confirmed, the numbers added up. The seller answered every question. The buyer did not hire a CPA to review the financials. They did not bring in an attorney until the purchase agreement was already in front of them. They did not work from a structured checklist. They worked from confidence. Everything looked good to them, so they closed. Then the discovery started. 3 months after closing, a school district contract representing 30% of revenue came up for annual renewal and went to competitive rebid. The company lost it. Then the phone calls started from vendors the seller had been slow paying for months, payables that were understated on the books and now belonged to the new owner. Then the receivables aging report revealed that a meaningful portion of what looked like collectible revenue had been sitting unpaid long enough that collecting it was no longer realistic. Then the cash position, which had looked comfortable at closing, started compressing in ways the buyer had no framework to anticipate. None of this was fraud. The seller did not fabricate documents. The buyer verified the seller's story. They never tested it. Here's what makes that painful beyond the obvious. A buyer who had run a proper diligence process with the right professionals and a structured checklist would have found these issues before closing. And finding them before closing means having options. Reprice the deal based on what you now know. Require a holdback to cover the exposure. Negotiate specific representations into the purchase agreement or walk away on your own terms with your capital intact before you became the person getting those phone calls. That is what structured due diligence actually does. It does not just protect you from bad deals, it gives you leverage in good ones. There is a 5-part framework for doing it right. 5 tests that go beyond the documents and into the real risk profile of the business you are about to own. Welcome to Main Street Ledger. I'm Kurt Rose, CPA, former entrepreneur, and CFO of an SBA lender. We cover small business acquisitions, SBA lending, franchise ownership, and business finance, all drawn from public sources and experience. If this is your first time here, subscribe below. This is education, not financial, legal, or investment advice. Most buyers treat due diligence as a collection problem. Get the tax returns, get the profit and loss, get the bank statements, check the numbers against each other and confirm they hold together. That process is not worthless, but it answers the wrong question. It tells you whether the seller's story is internally consistent. It does not tell you whether the story is complete. The gaps are where the damage happens. Receivables on the books that are not actually coming in. Payables managed down before closing to make the balance sheet look cleaner than it is. A customer relationship that is real but fragile. An owner who is personally holding together more of the operation than any document will show. One thing worth establishing before the framework starts. A profitable business on paper is not automatically a cash-positive business on day one. That gap between what the income statement shows and what you actually need to fund the first 90 days catches more first-time buyers off guard than almost any other post-closing surprise. The 5 tests are built to surface it before you sign. Before those 5 tests, one thing has to be in place. Due diligence is not a solo exercise. You need a finance professional who can read tax returns and financial statements with a critical eye. Not just confirm the arithmetic, but ask whether the numbers make sense for this type of business, this revenue level, and this industry. You also need an attorney who understands small business acquisition structure and what happens when something surfaces after closing. Think of that team as deal insurance. If their work uncovers a real problem and you walk, that fee was the best money you spent. If it confirms the business is exactly what the seller represented, it paid for itself in confidence. And one behavioral note, due diligence only works if you are genuinely willing to find a reason not to buy. Professional advisors give you the distance that is very hard to maintain on your own when you have been working toward a deal for months. The 5 tests are test 1, follow the money and verify it. Test 2, find the fragile spots. Test 3, test the owner exit. Test 4, look for deferred problems. And test 5, run the day after test. Here's how each one works. Test 1, follow the money and verify it. The financial statements a seller provides are internal documents. They reflect what the seller chose to record. The filed tax return is what the seller told the IRS. Those are not always the same thing, and the gap between them is one of the first things your finance professional needs to look for. Your finance professional's first job is to put both documents in front of them and reconcile the two. Any material gap between the internal books and the filed returns needs a clear explanation before you go any further. This step alone has changed the outcome of deals that look straightforward on the surface. Once the numbers are confirmed as real, the next question is where they actually come from. Not the total, the composition. Which customers, which contracts, which channels, and what percentage of total sales each one represents. The landscaping company had 50 commercial accounts. That looked like a diversified base. What it also had was one school district contract generating 30% of revenue on an annual renewal cycle. And that fact never surfaced because the buyer never asked for a customer level breakdown. Ask for it before you go any further. If the seller cannot produce it or will not, treat that as meaningful information. But knowing where the revenue comes from is only the first half of the question. The second half is how easily any of it could disappear. Test 2. Find the fragile spots. Customer concentration is the most visible version of this risk, but not the only one. A sole supplier for a critical input. A key piece of equipment with no redundancy. A software system only one employee fully understands. An informal vendor relationship the owner has maintained personally for years. Any of these can be the dependency that holds a business together while being completely invisible in the financials. Before you close, build a dependency map. Every material revenue source, every critical supplier, every key relationship. And for each one, ask what this business looks like the day that element is gone. If you cannot answer that question confidently from your diligence materials, you are not finished. Test 3. Test the owner exit. Many businesses in this price range run on the owner's personal relationships, their daily operational presence, or institutional knowledge that exists only in their head. Not documented, not trained into anyone else, and not transferable at closing without deliberate planning. A buyer who does not test this is not buying a business. They are buying a job that currently belongs to someone else. The practical test has 4 parts. Does the seller perform any role that is revenue critical, undocumented, untrained, and undelegated? All 4 conditions together means the business cannot function without them. Even one means there is a transition risk that belongs in the deal structure, in the length of the transition period, in written training obligations, or in a seller note that keeps them financially accountable for what they hand over. One step most buyers skip. Ask the seller for access to the business during normal operating hours. Visit the location. Watch how it actually runs. Where the seller permits it, have brief conversations with key employees. Most sellers will not agree to open-ended access, and the request carries more weight after an LOI is signed. Make the ask. A seller who refuses entirely is worth noting. What you are watching for is whether the owner is the center of every decision, and whether anyone in that building could keep things running without them. That answer tells you more about transition risk than any org chart will. Once you understand what the owner is holding together, the next question is what else has been quietly deferred until after you own it. Test 4. Look for deferred problems. Sellers preparing a business for sale have every incentive to present it at its best. One of the quietest ways to do that is to defer expenses. Skip a maintenance cycle. Hold off on a hire that has been needed for months. Let a vendor relationship drift on informal terms. Postpone a lease conversation. None of these appear on the balance sheet as liabilities. They appear in your first year of ownership as cash you never budgeted for. Your finance professional should run an aging analysis on equipment and review for unrecorded obligations. Your attorney should examine lease terms, particularly any approaching a reset. Go into this process assuming a deferred number exists somewhere in the business. Your job is to find it, size it, and either price it into the deal or make it a condition of closing. Clean books mean the accounting is in order. They do not mean the business has been maintained. Test 5. Run the day after test. This is not a 6th checklist item. It is how you apply everything above. Before you close, put yourself in the business on day 1 as the new owner. What worries you immediately? Specifically, which customer relationship feels fragile? Which employee might decide this transition is a good moment to leave? Which piece of equipment is overdue? What does the cash position look like on day 31? That question is the one most first-time buyers underestimate. A profitable business is not automatically a cash-positive business in the first 90 days. Here's the mechanism that catches people. Payroll hits on Friday. The invoice you sent on Monday does not clear for 30 days. Inventory purchased to fulfill a new contract leaves your account before the customer pays. That timing gap between when the work happens and when the cash arrives can create a real liquidity problem in a business that looks solid on every statement you reviewed. Before you close, calculate what it costs to operate this business for 30 to 90 days without a single surprise. If you cannot get to that number from the materials in front of you, you are not ready to close. A few things worth repeating before you go. Due diligence is not about collecting documents. It is about finding what the documents do not tell you. A finance professional and an attorney are not overhead. They are the mechanism that makes everything else in this framework actually work. Strong revenue totals hide concentration risk. Ask for the customer level breakdown before you proceed. The owner may be the actual product, and test whether the business functions without them before you close, not after. Clean books do not mean a maintained business. Deferred problems are real liabilities that will surface whether you found them in diligence or not. And a profitable business is not automatically cash positive on day one. Calculate the working capital requirement before you sign. The right question in due diligence is never whether this business is profitable. It is what would have to be true for that profit to disappear. If this kind of content is useful to you, subscribe below. More on acquisitions, SBA lending, and business finance coming regularly. Research the deal before you fund the deal.